Tuesday, November 28th, 2023, Maneco 64, home of alternative economics and contrarian views. Today, we're going to look at why the markets are giving not just the Fed, but Uncle Sam a big thumbs down for how they've handled everything in the last few years. Yes, we were supposed to have come out of a recession after the events of 2020-21. But yeah, Uncle Sam is indebted himself even more. Interest rates have kind of gone through the roof. The Federal Reserve has lost control of it, really, mainly because they held rates too low for too long, mainly because they did too much QE, they printed too much money. And now the markets are saying, yeah, it's no good. And we're going to look at gold and what it has to do with that as well. So before we look at why I think gold is given a thumbs down to what the Fed has been doing since really March 2022 when they started raising rates, we need to look at the U.S. economy. Yesterday we had some very weak numbers, and of course it's just 1 month and one number, but we're starting to see a lot of economic numbers show weakness. But yesterday we had new home sales. It was expected to come out at 721,000. Previous number was revised to 719. Not sure what the expectation was. Well, actually the previous was 759, so it was expected to drop to 721. They actually revised the previous number down 40,000, and the actual number came out at 679, so it's a huge drop. There might even be a new revision for this current number next month, who knows. And I was speaking to a friend of mine who worked in the markets, in the bond markets for a long time. He's the guy who offered me the job in 1992 when I was in Switzerland to come work in London. He has quite a lot of contacts, and I have to say I don't agree with everything he says, but he's been talking to some economists quite high up. I'll leave it at that. I don't have contact with these people, and I don't agree a lot with what they say, but what they're seeing is something that other people are seeing. If you look at August this year, Goldman Sachs reported 2 trillion corporate debt wall will spark job losses in 2024. September 2023, another story here, why a corporate debt's ticking time bomb could make, could make a 2024 recession inevitable, analyst warns. So this friend of mine called me yesterday, and he said the people high up, not everyone, they're worried because of these corporate rollovers. And apparently these companies whose debts are going to come due, they probably took these debts at a lot lower levels, maybe 3, 4, 5 years ago. And now corporate, not just U.S. Treasury yields have gone up, but corporate credit is gone up even more. They're even having to pay more. And that's probably why the housing market is starting to cool down. Mortgage rates as well are going higher. So he told me that these corporations that are liable to this corporate wall, rollover of old debt, they employ 22 million people. So yes, I'm not saying 22 million people are going to lose their jobs, but I would say they're going to put a hiring freeze, or they're going to have to get rid of people. They're going to probably not hire new people when older people retire. So it's going to hurt the economy. And I think, yes, they call them zombie corporations, according to him. I hadn't heard the term. I heard of zombie banks. So there's 1.5 trillion of basically junk bonds below investment that's coming due next year for renewal. You know, they're going to have to refinance. I'm not sure at the average at which they refinance, but let's say it's 3-4% a few years ago. Now it's 6 and 7, so it's kind of doubled. They've got 0.5 trillion of credit CLOs, which some kind of derivatives. Not good either. And you have to also look into the derivatives market. I didn't talk about the derivatives market, but I'm sure these corporate bonds, these CLOs, and also commercial leases are linked to a lot of derivatives, I would say, because Wall Street loves derivatives. So there's 0.5 trillion CLOs, 0.5 trillion of commercial leases, and it could really impact things according to these people. These corporations make up about 50% of the S&P, 50% apparently of S&P companies' debts are below investment grade. So there you go. So, you know, he sometimes calls me very doom and gloom, but he was saying these people are expecting a hard landing, not a soft landing, not avoiding a recession, but a hard landing. So I think things are going to get rough. And that's why the markets are giving the Fed and the Treasury a thumbs down. And why the Treasury as well? Well, because after a recession, when the economy is supposedly picking up, you're supposed to rein in government spending. The Keynesian stabilizers are supposed to come in. I hate talking like this because I'm not a Keynesian. So the stabilizers mean, you know, the government spending is supposed to stop. You know, deficit to GDP is supposed to come down, and the debt growth slows down, and everything's fine. But we've had anything but that because we haven't really had a natural recovery. It's been all funded by government spending, deficit spending, of course. We're seeing a huge amount of deficits being run, like 2 trillion a year, which is crazy, getting up to almost 10% of GDP during a supposed recovery. And what about the Fed? Why do I think the Fed has done a bad job, or gold is telling the Fed? And also the bond markets, investors are telling the Fed, because in the end of the day, it's not gold, but investors buying or selling gold that tell the Fed. Well, because they just went crazy in 2020-21 with the money printing. They printed more currency than had ever been printed before in the history of the United States. We saw their balance sheet go from like 3.5 trillion, or just around 4 trillion in 2019. They're doing QT, all the way up to almost 9. Yes, they've kind of tapered that balance sheet, but I think with what's coming, they're going to have to stop the QT. And they took too long to do it. They should have started raising rates a lot earlier, but as we know, they thought everything was going to be transitory, the inflation. And I think that's why they've done such a bad job. And I'm going to refer again to this book. Jim Sinclair talks about gold being a barometer of monetary rectitude and also fiscal rectitude. If the government's keep spending and borrowing, and those borrowing costs go up, it's a problem. And I think that's what gold is telling us. The other thing I would note about the economy that we were talking about yesterday with my friend is that in 2024, Americans are going to have a negative savings rate. We know already that credit card debt has gone over $1 trillion. And I bet those rates are going to keep going up as well, credit card rates. So not a good environment, and it will affect the stock market, the bond market, He's kind of bullish in the bond on the bond market. I'm not so bullish. I think yes, rates will come down, but they won't come down as much as people probably wish, like to 1 or 2%. I don't think we're going to see those rates again, and eventually we're going to drift over to after they cut, or if they cut, we're going to keep drifting higher to 5, 6, 7%. That's going to be the new normal. He seems to think that technology, a lot of the companies that aren't liable to this corporate rollover, they will do well. He seems to think that AI will make sure that investors don't sell everything, but I don't agree with that. I think it could spread everywhere, contagion, because if a fund manager or someone loses a lot of money in the sector, they're going to have to sell others, maybe for margin calls, or so I think it could be worse than he thinks. And so let me tell you why I think gold is giving a thumbs down. Well, you can see here the Fed started raising rates on March 17th of 2022. Rates were at the time between almost down to zero, and they raised it to 0.25 to 0.5, their target Fed funds. And I have to thank Paul from the Sirius Report. I saw that he tweeted it out yesterday that on March 17th, 2022, when the Fed started its rate hike cycle, gold closed at 1942. So there are a lot of people back then saying, well, this is the end for gold, because gold had topped that year in 2022. Let's see, the high here was 2065. It made a double top with the high from 2020. And everyone was saying, not everyone, but a lot of people were saying, oh, gold is going to crash, is going to go to 1,500 or 1,000. And here we are today, and gold is above 2,000. And I think we can safely say now that the Fed's rate hike cycle is over. Yeah, and does it mean they're going to cut? They could, and I think the markets are clamoring for it. Yeah, and gold has actually gone up. So it's telling us that the Fed's done a bad job, that the Treasury has done a bad job, and that investors don't approve. So, yeah. The other thing I wanted to show you is that some people might be saying, well, if they're going to start cutting, if they might even stop QT and do QE, why not buy Treasuries? Yes, and they give an income, and that's the enticement, right? The coupon. But if you compare, and I've looked at these charts before in the last few months, this is the price of gold divided by the 10-year note future. So this chart is going up. That means that you're able to buy a lot more treasuries with an ounce of gold. Yes, treasuries might do well, but versus the real measure of value, I think it's going to go down. So I think this chart is going to continue going higher. Treasuries could go higher in price and lower in yields, but I think gold is going to go higher at a quicker pace. And it's the same thing for the long bond future, the 30-year future, same kind of scenario. So there you go. With that, let's quickly look at where the markets are this morning. It's 8:38 a.m. London time. Spot gold is down just under $1 at 2013, excuse me. High's been 2018, the low's 2011.84. So it's kind of quieting down. Gold and silver. Silver's down about 5 cents at 24.58. Highs 75, low 52. The Dow futures down 15, Nasdaq down 37, S&P down 5. The currencies are actually pretty steady. Not much to report there. They're pretty much unchanged overnight. Aussie dollar, Canadian as well, and the Kiwi. What about commodities? Well, WTI crude is up just under 1%, 75.50. Platinum is unchanged at 922, and high-grade copper is down 1/3% at 379. And yes, bond yields did drop yesterday on the weak housing data. The 10-year yield right now, though, is up 2 basis points at 441. And with that, I'm going to wish you all a very good day. Take care. Bye.